Thanks, everyone. First of all, I'd like to thank our friends at the CME Group for co-hosting the event, and thanks everyone for coming today. I will spend a brief few minutes looking at technical analysis, which is obviously something that CQG has been specializing for the past 40 years. Although in the most recent years, we've spent quite a lot of time focusing on the aspect of execution, latency, and anything that goes with that. So arbitraging, algo trading, and so on. But we've not really lost focus on the root of our business, which is the decision-making aspect of trading. And technical analysis is just that. A lot of users, a lot of traders still use that, even though there are tools which are, some could consider them a little bit old-fashioned. But we have a lot of clients that make a living using those tools. So today I want to come back and sort of look again at these technical indicators and those that were and still are widely used and how they've evolved with time in a way that hopefully can help people in the room. We too have our own disclaimer, and even more so that I will be talking about things and signals that the markets and that technical analysis has defined as, bullish, bearish, and all this. So none of what I'm going to be saying is about to be taken as buy or sell recommendation. Anything has to be taken with a pinch of salt, if I may say. So for the longest time, the markets have been looking at a sort of limited number of tools to find out whether the market is being overbought, oversold, in a trend, going sideways. And a lot of these tools are and have been sort of based off averaging. So the good old moving averages and RSIs have been very, very popular. And interestingly, we have had a few partners that have taken these simple tools and just sort of had a different view and a different interpretation of these tools. And this is where I'll be showing you this next. Hang on a second. Sorry, we have two sets of slides, but I'm using the clearer one just so that you can see a little bit better. So the basics, first of all, is going to be the MACD. It's a tool that will use as its basis two moving averages of two different periods and just doing one period minus the other, which will give you the blue line that you see at the bottom. So the what we call MACD, the first line is going to be the blue line that you see there. And the MACD-A, which is what we call the signal line, is the red line. So the average of the difference of the first two averages. And it's quite popular, even though not only we're taking two moving averages, which already imply some delay in the reaction of the indicator, and we're further smoothing it with another moving average on top of that. And the important aspect of it here is that the crossings of the indicator is what's defining whether the market is supposedly bullish or supposedly bearish. So a cross in one direction would give you a bullish signal, supposedly, and a cross in the other direction, so the blue line crossing below the red line, would be giving you a bearish signal. What's interesting is one of the approaches of one of our sort of collaborating company, which is Joe Di Napoli, which provides a set of technical indicators within CQG and its different platforms. And the one I want to focus on today is the MACD predictor. What it does is that it allows the user to find out where the price of the next bar needs to close at in order for the indicator to cross. So when we look at this chart of crude, for example, so here we're looking at a 5-minute chart of crude, but it works on pretty much any chart. We see the indicator at the bottom in a slightly bigger way, so it's a little bit easier to see the crossing and the uncrossing. And the white line on top of the actual price on the bars behind that is at any point in time, where does crude need to close for the MACD to cross? And why this is kind of crucial is because, as we said, the sort of indicator is being followed by quite a few traders, and the few traders will have a lot of maybe automated systems or strategies that are taking these crossing as buy or sell signals. And over here, we have something that will tell us when potentially we're expecting such signals to happen. So whenever the price of crude closes above the white line, we need that particular price to close above it, that this is quite crucial. Then we'll know that the signal will be generated on the MACD. And it's important because if you have events that you know will happen in advance, like OPEC data coming out, imports data coming out, and so on, and you know that the market will move, and it can move to a point that will then make the indicator cross, that will further enhance the possibility of having a followed signal by certain types of traders. Now, this will allow us to move to a very similar and even simpler prediction, which is the moving average cross prediction. So just before that, we had the MACD prediction. Over here, we've got the same approach, but on an indicator that we're looking at on crude on a daily continuation chart, where we'll find out which price, represented in green here, is needed for the moving averages. Over here, we're doing a 10 and 20 moving average to cross. So again, this can tell us that if we're expecting a big news to come out and that we have a price that's likely to close either above or below the indicator, we know that the indicator will cross, and we know that further movement will follow. I'm moving into the sort of divergence-based approach, and this might sound confusing, but this is the MACD means moving average convergence, divergence, but here we're talking simply about the divergence of the indicator with the price. And we can see here that we've had another collaboration of indicators within CQG, which is that we can see that MACDs, RSIs, and a few other indicators can be used in a slightly deviated way, like we can see here, using our good friend Sean Downey's indicators and his interpretation of, in this case, the MACD. So what we see here is, again, we're looking at the same thing, an indicator on crude, on NYMEX crude daily chart. And here what's important is not necessarily just the crossing or uncrossing of the indicator itself, but the relationship between the crossing and uncrossing and what the price is doing when the crossing occurs. So the first thing that we see at the bottom in red is this kind of stepping up and down line. So the red line here is a line that shows whenever the blue line, so the MACD, crosses below its average over here, we will record the price of crude on the closing bar and record the price of crude at that particular moment. The green line does the same thing, but records the closing price of crude when the MACD crosses above its average. So we end up with these values stepping up and down. And what Sean really went after is, if you have an indicator like the MACD that has originally been used to show a trader a bullish signal on the cross of the blue line and its average, if the market doesn't follow on the actual price itself, meaning that you want to have a cross up on the indicator and the price going above the previous time the same indicator crossed up, then you have a sort of follow up and a step up of the indicator. Same thing for the step down. And it's going to be a little bit more sort of visually interesting on this side, sorry. So you can see that when this is happening, the market is going to react in a specific way. But what we're highlighting is the divergence of these two events. If you have an indicator that crosses up over different times, but the price is not doing the same thing, then you have a divergence in the indicator itself. So you want the two to be correlated in a certain way over a certain number of bars. You have to be fairly flexible because it does not always happen on the same bar. You may have a slight, 2 or 3 bar delay. So you have to have a little bit of flexibility for that to happen. So the divergence is one thing. But the next thing that's also interesting is taking it one step further and showing the way we can gauge how the indicator provides or not the sort of area where we are at on the trend, or if we're not trending at all. So what we're doing here is we're counting the number of times that the indicator steps up in the same direction until it stops doing that. So on the upside, we have the MACD. Oh, there you go. We have the MACD crossing up and stepping up multiple times up until the MACD crosses the other way around and then starts again at 0. And we can see that it does that a few times on the upside. On the downside, it's not that clear, which means that we're obviously mostly in an uptrend. But what's more important is when is the step up going to stop? And this is where it's reflected here with the pink arrows. And that tells us quite nicely that as soon as we have the indicator stepping up more than 3 or 4 times, so 4 is our limit over here, we can see that the market starts reversing. So obviously sometimes it takes a little bit longer, but it tells us where we're at in our trend, especially here in the uptrend. So if a trader is in a position and wants to know potentially how far is too far, that's the sort of indicator that we can derive from the MACD step up and step down. Another set of indicators that I want to show that is available and purely on an intraday basis is the range deviation pivots by shown down here again. So there's a few set of pivot points here that we can see. So these are the traditional pivot points that were originally calculated using the average of yesterday's high-low close. I don't know why I actually wrote that wrong. So it's the yesterday's high, low, and close, and we only basically look at the previous day's information. Here, what we've got for Schoen's deviation pivot is an average of n days of data. So rather than looking at yesterday's information only, we're looking at, I think the default would be 20 days. So we're looking at a whole month worth of daily ranges, and that will produce a specific line on the open of the day. And to that, we're adding some standard deviation. So 3 standard deviation, 1, 2, 3, and then 1, 2, 3. So what this does is it gives us more support and resistance levels to work with, which are a little bit more adaptive to the market, given the fact that we're looking at more data rather than just yesterday's information. The time average band, again by Sean, is something that will give the traders an idea of the average sort of volatility and the average range that is expected during at a specific bar during the day. So over here, for example, we can see that we've got a price of NYMEX crude again on a 15-minute basis. We've got bands with 2 standard deviations around it. And because the standard deviations are wider at this level, it means that specifically around this time, the price is not as sort of volatile as it should be, or that it has been over the previous 10 or 15 days in the past. So the market should really, on average, be a lot more volatile during that time period. On the other hand, over here, we've got a price shooting out of the standard deviations, which means that realistically, this particular move is unusual for this time of day. So because it's using a lot of intraday data, we can't really go lower than 15 minutes, but this is what this is telling us. The last part I want to touch quickly is automation of supports and resistance. Everything is sort of automated these days, and so we can actually provide a sort of a objective view of the market and whether we can automate these levels, because technical analysis is very much a subjective exercise when it comes to support and resistance. And over here, we have the ability to have a formula that defines prices where there might be some friction, either on the upside or on the downside. And although it looks a little bit crowded, it's just one way for traders to be able to backtest and have a less subjective understanding about the actual view of the market and how they can trade that. Is there a systematic way we can buy or sell a break, or if we want to buy a reversal on a support, or etc. So this is just a different way to look at it. Looking at RBOB over here on a daily basis as well, we can see that there are ways we can sort of do some testing on these. And lastly, on heating oil, something that also provides a little bit of a analysis. This is on a weekly time frame for this one. So it works on any time frame, but it gives some information. And that's to conclude the presentation. And I hope you found something of interest in this. Thank you.